As you'll see, there's a thin red line under there. That's the expectation on balance of probabilities technically that we had, that the gold-silver ratio first goes higher before we say goodbye to this basing descending grind line on the low side or the 75 level and begin our journey to run the 65 that we've been waiting for so long. That will eventually lead to a contagion to the downside given shortage of silver. And in actual fact, you'll be going the opposite direction.
The gold-silver ratio, a key metric that measures how many ounces of silver are needed to equal the value of 1 ounce of gold, rose to 89.97 on Friday, up from 89.21 on Thursday. This shift highlights continued challenges for the silver market, as noted by Francis Hunt, who recently pointed out that the ratio has deviated from its anticipated trajectory. Silver's price fell on Friday, trading at $28.96 per troy ounce, down 0.52% from $29.11 on Thursday. According to FX Street data, silver has posted a strong performance this year, up 21.70% year-to-date despite this decline. Analysts attribute this growth to macroeconomic factors and rising industrial demand, which have bolstered silver's appeal. The head of commodity strategy at Saxo Bank suggests that these drivers could enable silver to outperform gold by 2025. However, Hunt notes that broader macroeconomic dynamics, such as an unexpected rise in U.S. 10-year yields despite Federal Reserve rate cuts, have added pressure to the silver market. This divergence, coupled with a slowdown in the Fed's rate-cutting pace, has sparked concerns about prolonged headwinds for silver before any sustained upward momentum can resume. On Wednesday, the Federal Reserve announced a quarter-point interest rate cut, lowering its key lending rate to 4.25% to 4.50%. While this move was anticipated, policymakers surprised markets by signaling a slower pace of cuts in the coming year, reducing expectations from 4 to just 2 cuts in 2025. The announcement triggered a sharp sell-off across financial markets, further complicating the outlook for silver. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Once this particular gold-silver ratio failed to follow through on this break and return move and set up a new technical structure, we were awaiting this. It felt so good. It looked like we were going to get away. Silver then traded around 34.8 at that point. We got put back above the 75 level, got taken all the way back there. That was no longer just a simple return move. We said that has changed structure, and in fact the framing technically now means the can has been kicked down the road for when silver does its magic. I know it's not the news you want to hear. You've got this capping descending grind line that has been respected multiple times. Here you kind of came within proximity of it there, here, and along again on many return moves there, and then again there, 3 in short succession with small pullbacks, bounce back up, small pullback, bounce back up, finally a spill away, and then twice over here. We said eventually the potential is now more likely, and we put the red line always, you'll see there's a thin red line under there. That's the expectation on balance of probabilities technically that we had, that the gold-silver ratio first goes higher before we say goodbye to this basing descending grind line on the low side or the 75 level and begin our journey to run the 65 that we've been waiting for so long. That will eventually lead to a contagion to the downside given shortage of silver. And in actual fact, you'll be going the opposite direction if you were to break. And as I take this off, last night you broke to the upside. That means these potential localized highs at around 89.90 are quite likely to be run. You are going to be putting in higher gold-silver ratio valuations. That's a 90, that one, that's an 89.7. And you could in fact run these at 92. That was around 91.8. And the last big high that you had was 96. So we've got a lot of localized levels. You can see these lower alerts are not running, and all my alerts for higher up have been triggered. And I fear this points to an underperformance period of precious metals generally, and specifically more so silver. And this is what you'll be seeing on the silver charts when I put it in front of you. And this rolling interest rate surge, which is as the Fed is cutting rates, The US 10-year is actually going up in the opposite direction. We brought you the gold-silver ratio. You can see what it's doing to silver right now. By the way, we have a macro positive structure, but if you pull all the way back into our funnel, right the way down to our midpoint somewhere around here, you could be right down to, low 20s if that happens. In the long term, silver has a huge move to offer, but people are jumping too soon through the stages. Big dominoes are leaning and rocking and need to be allowed to fall. They'll topple, they'll hit the next one, wait for it to wobble, wait for it to start tipping, to start fall. If you jump to the end before you allow the processes to play, you've gone long silver at 34.8 and you're watching it at $28, $10 less and chucking it further down. I'm a net accumulator investor and are happy to hold through all of this and have bought at much lower levels as a long-term plan because of fear of unobtainium. But in terms of trading, you've got to watch it. This is bearish. This is bearish. This is selling the things that are nailed down right now. There's a real fear. There's a super overvalued stock market. There's a hyper overvalued bond market that nobody wants anything to do with really anymore, which is why the rates are moving in the first place.
The U.S. debt market is under immense strain, with rising interest payments and reduced demand for U.S. bonds driving higher rates. Francis Hunt attributes this to decades of unsustainable fiscal policies, culminating in a severe systemic crisis. Meanwhile, Congress faces a Friday midnight deadline to raise the debt ceiling, the nation's borrowing limit, to prevent widespread government shutdowns. Efforts to extend the deadline until March 14 through a bipartisan bill were derailed after President-elect Donald Trump opposed it, following lobbying from billionaire ally Elon Musk. An alternative Republican-backed spending bill endorsed by Trump proposed a 2-year debt ceiling suspension tied to government funding. However, this measure also failed to pass the House of Representatives on Thursday, leaving the impasse unresolved as the deadline approaches. These developments amplify existing vulnerabilities in the debt market. Rising interest rates and ballooning debt payments point to systemic instability. Let's get back to the interview.
I'm going to grab on top of this the SPY and show you that chart. That one had a lovely little first inverted HVF on a very small time frame, roughly a half-hour time frame in there, a little squeezy Japanesey again. Look at that. After making that high and that pullback, look at this. Absolutely textbook squeezy. There she goes. And a spiller, an absolute thriller all the way from Manila. It looks like we've opened up and you are currently trading down at the moment. And that is the first in a new trend. You would have had your stop there. You would have entered short there. You would have absolutely made a great trade. And overperformance applies to first setups and new trends. This has all been a bull market run. That's quite a big recent high. I am on the 30-minute though. I can take you out. But that is a nasty little absence of bid. Why? Debt markets. The guys that are big fanboys for the dollar, and look how strong the dollar is and everything else is battling against the dollar. Debt markets. Your debt market in the US has collapsed more than anyone else. That is a signal that you see the rates spiking. That is because of excess debt, super high interest payments. You've broken the system. Well done. You did it, Janet Yellen. You're the last one to finish it. It started under Greenspan. It got here and you have broken it. The 40-year bond market is certainly over. We're probably going to run the 5-year on that 10-year. You're having key seminal macroeconomic events happening right here, right now, with major triggerings. If you think this is going to be small and it'll pass over, I would say think again. Too many big triggers, 30-year patterns on the Korean won against the dollar. Extreme dominance of the dollar right now on higher interest rates being paid based on the fact that the debt bid is not there right now. In an environment that the person who supposedly controls the rate set is going in the opposite direction and the market is going, no, that way. That's what's happening right now in the world, friends. This is a well-timed precursory wobble that could see big stuff come down. Right about as Donald Trump takes the presidency. What do you think? Wouldn't they just love that? We've said many times before, center-right politicians, none of them work for you, by the way, are the favored choice for collapses. It makes more sympathy for the cultural Marxists on the left-hand side when they undermine the financial austerity or sound money principles supposedly of the right.